So imagine for a second that a human bank teller, accidentally adds an extra zero to your car loan.
Right, which happens.
Yeah, it happens.
Yeah.
But a human branch manager can just, well, look at the paperwork, realize a mistake, and fix it.
Exactly. It's a quick fix.
But what if an autonomous artificial intelligence system decides you just aren't worthy of a mortgage, and it bases that on some hallucinated data point buried deep inside this massive algorithm? I mean, who do you actually sue in that scenario?
Yeah, that is the literal nightmare scenario right there.
Right. So today we are on a mission to unpack this highly complex regulatory framework that's actually designed to answer that exact question. We're looking at how the financial world is, frankly, desperately trying to build safety nets around this massive explosion of AI.
And it is moving fast.
It really is.
Mm-hmm.
So to do this, we're drawing on a really detailed analytical post by an author named Navi. And this post breaks down the Reserve Bank of India's draft guidelines for model risk management and AI governance.
Which I know sounds like a very dry title.
Yeah, model risk management sounds like a textbook you'd use to prop open a door, but it's secretly about establishing the rules of engagement for how algorithms are legally allowed to interact with your wallet.
What's fascinating here is that this framework actually represents one of the most mature regulatory approaches to AI governance we've seen so far in India.
Really? The most mature?
Oh, absolutely.
Yeah.
I mean, to understand the scale of this shift, if you look at Chapter 6 of the draft, it clarifies that these new guidelines are effectively replacing a guidance note on credit risk management that dates all the way back to October 2002.
Wait, 2002?
Yes, 2002.
That's like pre-smartphone era.
Right. That previous guidance was written when basic digital banking was still a total novelty. And now, we're dealing with generative models that can rewrite their own operational parameters on the fly.
That is a massive leap. So the regulators are just playing an intense game of catch-up here.
Precisely. They have to.
Okay, let's unpack this. Because before we can even talk about how regulators plan to stop bad AI, I feel like we have to understand what they even consider an automated decision in the first place.
That's a great starting point.
Yeah, so according to Chapter 2 of the draft, the RBI mandates that a regulated entity, so like your local bank, they are fully accountable for the outcomes of all models.
Notice that focus on the word outcomes.
Right. And Na'vi specifically notes that it doesn't even matter if the bank built the tool in-house with their own engineers or if they just bought it off the shelf from some third-party tech vendor. The bank is totally on the hook for the final outcome.
And, focusing purely on the outcome rather than the underlying technology is just a highly strategic move by the RBI.
How so?
Well, regulators know they can't possibly keep up with the daily advancements in coding languages or neural networks. It changes every week.
Oh, sure. Machine learning frameworks update constantly.
Exactly. So by anchoring the regulation to the outcome itself, they completely bypass the need to update the law every single time a tech company drops a new software version.
That makes me think of a city health inspector visiting a restaurant.
Oh, I like that. How do you mean?
Well, the inspector doesn't waste time analyzing the specific brand of the convection oven, right? Or debating if the chef's knives should be carbon steel or ceramic.
Right. They don't care about the tools.
Exactly. The inspector's primary concern is just whether the food coming out of that kitchen makes the customers sick.
That is a perfect analogy.
So regulating the outcome means the bank is ultimately judged on the safety and the fairness of the financial meal they serve you, completely regardless of the digital kitchen appliances they used to cook it.
That is the exact mechanism at play here. And to ensure no one escapes this outcome-based scrutiny, the draft provides this incredibly sweeping definition of what actually constitutes a model.
Right, I was reading that. It breaks it down into 3 parts, doesn't it?
Yes, 3 distinct sequential components. First, you have the input component, which is the raw data, the hard-coded decision rules, the statistical assumptions.
Okay, input makes sense.
Then second is the processing component. This is essentially the black box, where the math, the statistics, or the AI actually analyzes all those inputs.
Is the actual brain of the thing.
Right. And finally, there is the output component, which is the actual business or operational decision that the system generates.
I notice how incredibly broad that definition is. I mean, by defining a model simply as input, processing, and output, the source notes this regulation applies to, complex frontier algorithms, but also an internal Excel sheet.
Yeah, even a spreadsheet.
If a basic spreadsheet takes client inputs, processes them with a few simple formulas, and outputs a recommendation that impacts a financial decision, It is legally classified as a model.
It absolutely is.
That level of thoroughness seems almost aggressive to me. I mean, it feels like they're deliberately targeting the lowest common denominator of Office software.
Well, they are targeting the loopholes, right? Because historically, when new regulations drop, institutions immediately look for safe harbors.
Right, they're trying to find a way out.
Exactly. A bank might try to dodge the intense scrutiny required for an AI by claiming, oh, this tool isn't advanced machine learning, it's just a series of basic macros on a spreadsheet.
We just use it to calculate variable interest rates, nothing fancy.
Precisely. But if that simple spreadsheet contains a flawed formula, it carries a massive material risk to your financial life. So sweeping everything into this broad definition forces the institution's board of directors to actually take ownership.
They can't just hide behind the simplicity of the tool.
No, they cannot.
Right.
They have to approve a comprehensive model risk management framework, or MRMF. And the Post specifically points out this framework must align with DGPSI principles.
Yeah, Navi mentions DGPSI, the Data Governance and Protection Standard of India, but what does aligning with those principles actually require a bank to do differently on a random Tuesday morning?
So DGPSI represents a highly mature approach to handling information. It requires very strict data mapping and localization.
Meaning they have to know exactly where the data is.
Exactly. A bank can't just dump all its customer data into some giant unstructured server and just let an AI feast on it.
No free-for-all data buffets.
Right. They have to catalog every single byte of data, know exactly where it lives, document exactly who has access to it, and crucially ensure explicit user consent is tied to how that data is processed.
Wow, okay. So integrating that into the MRMF means the board can't just plead ignorance about what data their algorithms are chewing on.
Exactly. Ignorance is no longer an excuse. And furthermore, the board has to adopt what's called a deviation justification document based on the entity's risk absorption capacity.
Risk absorption capacity, that implies a literal financial threshold, right? Are they calculating exactly how much cash they can afford to lose if a model suddenly goes rogue?
That is precisely how it works.
Okay.
It's essentially a financial and operational stress test.
Okay, give me an example.
Sure. So the board has to look at a model, say an automated commercial trading algorithm, and calculate the maximum potential capital loss if that algorithm executes incorrect trades for a full hour before anyone notices.
A full hour of bad trades, yikes.
Right. And if that projected loss exceeds their safe capital buffer, they basically have two choices. They either don't deploy the model at all,
Or
the board of directors must sign that formal deviation justification document.
Right.
They have to explain, in writing to the regulator, why they are willingly taking on a risk that exceeds their standard absorption capacity.
Oh, wow. So it forces senior management to put their own personal reputations on the line.
Exactly. Makes it very personal for the board.
But wait, if every single formula-heavy spreadsheet and complex trading algorithm requires this intense level of board oversight, I mean, the logistics of tracking all that would just paralyze a bank.
They would think so, yeah.
How does an institution actually implement this without completely freezing their day-to-day operations under just a mountain of bureaucracy?
Well, Chapter 3 of the draft introduces the necessary pressure valve for that, which is risk-based model tiering.
Okay, so they categorize them.
Yes. Institutions aren't expected to apply the exact same rigorous board scrutiny to, say, the Office holiday party budget spreadsheet as they do to their primary mortgage approval neural network.
That makes sense.
The guidelines mandate classifying all models into categories, typically high or low risk. And this classification has to be reviewed at least annually.
I would assume that risk assessment is mostly based on the dollar amount the model manages, right?
Financial impact is a major factor,
Yeah.
sure. But crucially, the guidelines also mandate assessing the potential implications for the consumers.
Oh, interesting. So not just the bank's money.
Right. Think about a model that determines whether an individual gets flagged for financial fraud. It might not move millions of dollars of bank capital.
But it ruins someone's week.
It has a catastrophic risk profile for the consumer. So models deemed high risk require approval by a dedicated, specialized committee. And regardless of the tier, every single automated tool must be logged in an exhaustive model inventory.
The author compares that to the process inventory under the DGPSI framework. It just sounds like a massive, constantly updated ledger.
It really is, detailing the model owners, developers, validators, and all the technical dependencies.
But the source material also outlines what it calls the 3 lines of defense for managing these models once they are in that inventory.
Yes, the 3 lines are critical.
So looking at the first line of defense, the draft states the model owners themselves are responsible. But wait letting the people who built the model and benefit from its deployment be the first line of defense.
I know what you're going to say.
That seems like a massive conflict of interest. They're essentially grading their own homework. How is that safe for the consumer?
Well, if the model owners operated in a total vacuum, you're right, it would be a severe structural flaw. They obviously have an inherent bias toward deploying their tool quickly to see a return on their investment.
Exactly. Move fast and break things.
Right. But the whole architecture relies on the friction created by the second and third lines of defense to neutralize that exact bias.
Okay, so what is the second line?
The second line is an independent model risk management and validation function. These are specialists who operate entirely outside the reporting structure of the model owners.
So a totally separate team.
Completely separate. And their explicit job description is to aggressively stress test and actively attempt to break the model.
But how do they actually break it if they didn't write the underlying code?
They use what's called adversarial testing.
Adversarial testing.
Yeah, so if the first team builds a credit approval algorithm, the validation team will intentionally feed it edge case or just completely corrupted inputs.
Oh, like trying to trick it.
Exactly. They'll input profiles of applicants with like a 10,000% debt to income ratio. Or they'll use completely fabricated synthetic data designed to mimic a sudden catastrophic economic crash.
Just to see what it does.
Right. They monitor the processing to see if the model panics, if it hallucinates new rules, or if it approves loans it absolutely shouldn't.
Okay, so if the second line of defense is doing all this crazy adversarial testing, then the third line, they must be auditing the actual validators, right?
You've hit the nail on the head.
Making sure the testers aren't getting lazy or, cutting deals with the model owners.
Exactly. The third line is a really robust internal audit function. They aren't looking at the code itself. They audit the governance process.
Got it.
They verify that the model inventory is accurate, that the tiering system is being applied correctly, and that those validators are truly independent.
Wow, okay.
And bringing this whole framework out of the server room and into the real world, the regulations explicitly mandate that the institution's grievance redressal system must cover consumer risks arising from these models.
Wait, really? So this means if an automated system unjustly denies you a business loan or, incorrectly flags your checking account for suspicious activity, you aren't just shouting at some useless customer service chatbot.
No, you are not.
Because of these three lines of defense and that meticulous model inventory, there is a documented, fully auditable chain of command.
Exactly.
The bank cannot legally just shrug and say, oh, well, the computer made an error and we don't understand it. They have a literal paper trail of exactly who owns the model, who validated its parameters, and the specific procedures for how your grievance has to be addressed.
It forces transparency into a domain that traditionally really relies on opacity.
That is so empowering for the listener.
It is. However, I will say, standard statistical algorithms with fixed parameters are relatively easy to audit. Chapter 5 of the draft tackles the much more volatile frontier, which is generative artificial intelligence and third-party black box models.
Here's where it gets really interesting. Because standard algorithms follow predictable rules, right? But modern Gen AI can be just wildly unpredictable.
Very much so.
Let's say a bank licenses some cutting-edge AI tool from an outside vendor to analyze customer sentiment. That tech vendor is going to treat their algorithm as a heavily guarded trade secret.
Oh, absolutely. It's their cash cow.
Right. They are not going to hand over their source code to the bank's internal audit team. So if the bank can't see the code, how can they possibly validate the processing component?
Well, the guidelines are unambiguous on this exact scenario. If a third-party provider refuses to disclose adequate information about the inner workings of their model, the regulated entity cannot simply pawn off the risk onto the vendor.
They can't just point fingers if things go wrong.
Nope. The bank must identify the operational blindness this creates and establish strict mitigants. If they cannot confidently validate the processing, they are required to severely limit the usage of that AI.
Meaning they restrict it from making high-stakes consumer decisions.
Exactly. Ignorance of the vendor's code does not grant the bank immunity from the outcome.
Now, Navi specifically highlights the massive risk of AI hallucinations in these scenarios. And, we have all seen examples of chatbots confidently inventing historical facts or citing completely fake court cases.
Yeah, the legal AI debacles have been famous
Yeah.
recently.
Right. So the draft requires institutions to implement strict control boundaries, specifically like system-level controls or design features to mitigate these hallucinations. But practically speaking, how does a system-level control actually stop a generative AI from hallucinating a brand new, totally incorrect interest rate during a live chat with a customer?
It really requires implementing what we call architectural guardrails. A bank simply cannot allow a generative AI to communicate directly with a customer in a fully unconstrained environment.
So they put something in between.
Yes, a system-level control often involves a secondary, purely rules-based algorithm that sits right between the AI and the customer.
Okay, like a filter.
Exactly. Its only job is to intercept the AI's generated response and basically fact-check it against a locked internal database of current interest rates and approved policy documents.
So if the AI generates a chat saying, hey, your rate is 2%, when the locked database says 5%.
The guardrail triggers an error. It blocks the message before the customer ever even sees it.
That makes perfect sense. It's like a digital chaperone.
That's a great way to put it. Now, the guidelines also emphasize mitigating the fundamental building block of all AI, which is the data itself.
Right. Bad data equals bad AI.
Exactly. Institutions must address data risks, which means ensuring data quality, actively preventing non-representativeness or bias in the training sets, and guarding against the breach of intellectual property rights.
And Navavi adds a really important analytical note here, pointing out that personal data protection must be deeply integrated into this step.
Yes, very crucial.
Because an AI trained on unethically scraped personal data is just a ticking legal time bomb for a regulated bank.
Oh, a massive liability.
But what caught my attention most in Chapter V was the requirement to constantly monitor for drift. The source mandates monitoring for both data drift and concept drift. What does it actually mean when an AI drifts?
So drift is a critical failure point in machine learning. It occurs when the real world evolves, but the AI continues executing its decisions based on an outdated statistical reality.
Okay, so give me an example of data drift.
Right, data drift happens when the underlying properties of the input data change significantly over time. Imagine a bank deploying an AI trained to detect credit card fraud, but it's based entirely on consumer spending habits from 2018.
So a completely pre-pandemic data set.
Yes, exactly. Then the pandemic reshapes the entire global economy, and suddenly millions of consumers are buying groceries online at 2 in the morning.
Because they're stuck at home.
Right, the fundamental definition of what fraud is hasn't changed. But the data, the statistical baseline of normal human behavior, has drifted dramatically.
So if the institution doesn't update the AI's parameters...
It will start freezing accounts every single time someone buys milk after midnight.
Oh, wow. Okay, so if data drift is the input behavior changing, then concept drift must mean the actual goalposts have moved, right? Like the definition of the target variable itself has fundamentally shifted.
That is an excellent deduction. And concept drift is far more insidious.
How so?
Consider a commercial bank using an AI to predict the safety of long-term commercial real estate loans.
Okay.
Prior to the widespread adoption of remote work, a corporation signing a massive 10-year lease for a downtown office skyscraper was a really strong indicator of financial stability and growth.
Oh, absolutely. A safe bet.
But today, depending on the industry, a company taking on that much commercial real estate overhead might be viewed by risk managers as a really dangerous liability.
Right, because nobody's in the office.
Exactly. The AI is still perfectly executing the rules it was originally taught, but the very concept of what constitutes a safe commercial loan has been rewritten by massive macroeconomic forces.
Which perfectly illustrates why a bank cannot just launch an AI, set it to autopilot, and walk away. Constant recalibration is required.
Always.
And that actually brings us to the ultimate safety net outlined in the regulation, which is mandatory human oversight and the requirement for a kill switch.
Yes, the kill switch.
Which I have to say, the term kill switch feels a bit cinematic to me. Like, instead of a dramatic red button on a factory floor, it sounds more like a standard circuit breaker in your house.
That's a good way to look at it.
When you plug in too many appliances and draw an unsafe amount of power, the breaker trips automatically to just prevent the wires from catching fire.
If we connect this to the bigger picture, the circuit breaker analogy is highly accurate. The RBI mandates that there must be override, suspension, or deactivation mechanisms built right into the architecture.
So someone has to be watching.
Yes. We're talking about human-in-command arrangements. This can take the form of a human in the loop, where a person must actively authorize the AI's recommendation before it executes.
Okay, so active permission.
Right. Or a human on the loop, where the AI operates autonomously, but a human monitor watches the live telemetry.
And what happens if things go wrong?
Well, if the AI model begins exhibiting wild latency or executing trades outside of normal parameters or pulling data from unapproved external servers, the system automatically trips the breaker.
It just cuts it off.
It immediately halts the automated processing and routes all pending decisions back to a human risk manager. No matter how deeply integrated the technology becomes, human beings must hold the ultimate authority to sever its connection to the financial ecosystem.
Wow. So what does this all mean for you, the listener? We have journeyed from a remarkably outdated 2002 credit guideline to a highly sophisticated DGPSI-aligned AI governance framework.
It's been quite a ride.
We've explored how regulators are forcing banks to inventory every automated tool. We looked at the crucial mechanics of the 3 lines of defense and the implementation of architectural guardrails to prevent generative hallucinations and statistical drift.
And really, the core takeaway here is one of structural empowerment.
Absolutely.
The financial industry's momentum toward total automation is pretty much inevitable at this point. But regulators are rapidly constructing a rigid architecture of board-level oversight and human accountability to contain it.
And knowing this framework exists provides you with leverage. When an automated system impacts your financial trajectory, you have the regulatory backing to challenge it. You can be confident that an auditable trail of human responsibility stands right between your assets and some opaque algorithm.
Exactly.
It is genuinely reassuring to see regulators working to keep human judgment in the driver's seat.
But, before we wrap up this deep dive, I want to look at the horizon. Based on the mechanisms we've explored today, what is the lingering challenge that this framework hasn't fully solved yet? That's a really great question.
Yeah.
And it raises an important issue regarding the actual physical limits of human cognition.
Human cognition? How do you mean?
Well, the RBI mandates human oversight and a circuit breaker for these models,
Yeah.
right? Relying on a human on the loop to recognize when things are going wrong.
Right, someone watching the telemetry.
But as generative AI and automated trading algorithms become exponentially faster and just vastly more complex, operating at speeds measured in literal microseconds, we have to ask a really difficult operational question.
Which is?
Will a human supervisor actually be able to comprehend an anomaly,
Yeah.
process it, and physically react fast enough to know when to trip that breaker?
Oh, wow.
We're rapidly approaching a speed of financial computation where we really must wonder if true human oversight remains a viable long-term strategy, or if it's merely a temporary psychological comfort we mandate just to feel safe while the machines outpace us.
That is, yeah.
Yeah.
If the algorithm identifies a market variable and executes 1,000 decisions in the time it takes a human auditor to literally blink, that circuit breaker might never get pulled in time.
It's a very real possibility.
That is a sobering reality to ponder as you watch these financial technologies continue their relentless evolution. Thank you so much for joining us on this exploration of the future of financial regulation.
It was a pleasure.
Remember, as the architecture of money becomes increasingly invisible, there are complex systems being engineered right now to ensure someone, somewhere, is held responsible for the outcome. Stay curious, keep asking questions, and we will see you on the next deep dive.